G'day guys, welcome back to another installment with the Ugly Investor. Today I really want to talk to you about being very clear with a financial plan. When financial decisions come in your life, and they happen on the daily, you know what direction you need to be heading. You can base your financial decisions on some level of clarity to your own individual plan. Now, is my plan and your plan going to be the same? No, it's not. And that's perfectly fine. There's no one plan that fits all. Everybody has their own unique work goals. Everyone has their own unique lifestyle, plus relationship, religious, spiritual, whatever those goals may be. But by understanding and writing down what those goals are or what you're looking to achieve, specifically in a 1, 2, 5, and a 10-year long-term financial plan, you can really make headway with the decisions in the now, because that will reflect what's happening in the short, medium, and long term for your own financial decisions. Recently, a good friend of mine approached me. They purchased a property for $350,000 a few years ago, and it had been affected by flood damage. And so they wanted to know, was it right to sell while it's flood damaged? Was it right to go through the insurance process and sell afterwards? Or should they go through the insurance process, renovate it, and then put it back on the market? Now, these are only 3 plans or suggestions that they had, and it's the only ones they wanted to consider. They were either looking for a cash payout now to reinvest the money into a different deal, or wondering whether they should keep the existing property once the insurance was finished and then continue to rent it out as they had been already. So we sat down and we took a look at all of the options that they had presented or that they were interested in. Let's be mindful that though my friend has indicated 3 options they wish to consider, there are plenty of other options out there, such as subdividing or developing on the land itself. Bearing that in mind, let's just do a quick analysis on these 3 options so that you can see how we would tackle this problem. Option number 1 was selling before renovating. The insurance company indicated that there was 2 options when they had accepted the claim on the insurance for the flood damage. Option number 1 was that they would pay out what they believed to be the cost of renovating the property, and they estimated that at $150,000. Option number 2 was to invest that $150,000 into doing up that place and getting it back in a completed state. So, under option number 1, my friend could, knowing that he's purchased the property for $350,000, receive $150,000 in cash from the insurer and then sell a flood damaged property back to the market. Now, you won't get premium dollar for this, but it does mean you don't have to go through the hassle of holding on the property and dealing with the builders and the insurance agencies through what would be months of work on this piece of real estate. And so it's a method of extracting cash now to be able to do something with it in the immediate so that you could get a potentially better return on your money. So let's take a look at the numbers. They bought the place originally a number of years ago for $350,000. They managed to find a builder who was interested in doing the project themselves. This becomes a win-win situation because the builder has the skills and expertise to complete the job cheaper than what the insurance company would be able to do, and therefore if he took on the project, he'd be able to take on the profit of the finished product. The builder was willing to pay $350,000 to purchase the property from him in that current state of flood damage. So what you can see is that the market has actually moved over time such that the original buy price is equal to the sell price in a flood damaged state. The net position that my friend would have would be 350 buy minus 350 sell plus $150,000 from the insurance company. Of course, you would incur tax for the profit you received of $150,000, and for simplicity's sake, I just assumed it to be 25%, which equals $37,500. That nets you a cash position of $112,500 for selling the house before the renovation is complete. What does the deal look like once the renovation is complete and you decide to sell at that point? Well, getting some appraisals is the best way to get an indication of what your property might be worth in the market. So I encourage them to go out, speak to some real estate agents. It's free to get an appraisal. And so a few real estate agents would come through the place, knowing the property, knowing the area, and give a market appraisal for what it would be worth in a finished state. They believed that the finished state would sit around $550,000. So a sell price at $550 minus a buy price of $350 gives you a gross position of $200,000. With tax at 25%, that would be a taxable amount at $50,000, giving you a net position of $150,000. So you would increase your total net position by around $38,000. Now, why would you choose this option over the first one? Well, obviously, there's more money in it for you. There's also the advantage that under the insurance policy, you are getting lost rent. So while the insurance agencies are taking their time to get the property into a completed state, they're in fact giving you lost rent for the amount that it was rented prior to the completed job. Now, the rental market was actually lower in the state that the house was before it would be in a completed state. So you'll get a lower return on your money, but nonetheless, it would still cover all the expenses that they were otherwise getting from their existing rental situation. So really, it's a win-win solution for my mate. So long as he doesn't need the money now, immediately, to manage any kind of expenses that he has to deal with, he can afford to wait out that time and get an extra $38,000 over the course of, say, a standard 6-month renovation. All that while, it's like a tenant has never left because the insurance agency is going to pay his rent for him over that period of time. The disadvantage of doing this is the stresses involved in completing this process. You would think it would be hands-off, but it's not. You typically have to get deeply involved, making sure the insurance agencies and the builders are liaising with each other effectively in order to get the job completed. Because what you want is to see the property completed as soon as possible. That way, if you were planning to sell it, you can access that cash now. You do have to be mindful, of course, that you're going to be subject to inflationary movements as well as interest rate movements on the loan using this example. The next option that he wanted to explore was what would happen if the property was finished and we kept it after the renovation. So we know that the value of the place was going to be worth around $550,000. The purchase price was $350,000, which meant that the net equity position that he would have in this particular space is $200,000. Under the tax laws, you do not have to pay tax on unrealized capital gains. So in this position, they have made a net equity gain to their net worth of $200,000 without having to incur any tax on it. You can, under this state, refinance at 80%, meaning that you would be able to withdraw $160,000 to be able to go do a different deal. This position here is the best position from a net worth and net cash position if he needed to do something with that money or wanted to purchase another piece of real estate. What's interesting to note is that under the appraisals that were obtained for this particular house, it was indicated that the rent would be approximately $27,500 per year. And so this is where you get to see the numbers in action. Here you can see very simply that the return on the original investment of $350,000 would mean that you would be getting a 7.85% return on your investment. Now that is a phenomenal result. However, what you do need to consider is the return on the existing or current market value. which I find helps you make more informed decisions for your investing journey. If you take a look at what the current market value is, which would be in a completed state, $550,000, that would mean that instead of a return of 7.85%, it would be the 27,500 divided by the 550 as a percent, 5%. So in fact, in current market terms, the rental return that he'll be getting would be a 5% return on his investment. If you have a financial plan, you would know whether these numbers meet the criteria that you are looking for in your investment model. If you thought, I can achieve a better result than 5% in the current market somewhere else, this would be a trigger for you to sell the property and take that money out, buying a different piece of real estate or a different investment that otherwise met your return on value requirements. Most people forget to take into consideration return on value. They're always referring to the initial purchase price that they made. It does not make sense to do this over the long term. A very easy method to determine whether your property is tracking well is to ask yourself, would you purchase the property at its current market rate? If the answer is no, then that would be the trigger for you to consider selling the real estate and purchasing something else that would otherwise get you a higher return on your money. Now, as it turns out, you can see these three options next to each other with all of the numbers. There is no right or wrong answer for whichever decision you want. Option number one is a low stress, instantaneous income injection, which would be very, very useful for people who had expenses that they needed to cover immediately, or looking to do something or jump into an investment immediately and take advantage of any particular trend that might be happening in the marketplace. Option number two is better for somebody who is potentially looking to maximize the return of this particular property. They're unsure of what's happening in the marketplace right now, but what they are sure of is that they can hold out for the better return. So it would be wiser to hold off, receive the stable income from the insurance agency, and then on sell under the current market conditions to get a net position that is greater. And option number three gives you your greatest net worth position. It allows you to keep a property that is income generating, and if you so choose, you could refinance that without incurring any tax to create another investment in the future. Now, when considering why option 3 might not be the best option, the best justification would be whether or not you have the correct structures. If you were using the incorrect structures to purchase investments, you would otherwise need to sell the real estate in your existing structures. This way, you can reset with the correct structures, allowing you to propagate yourself into a better financial situation over the long term. This is why it is very, very important to understand why you need to have a financial plan. By knowing what your plan is, where your goals are for the short, medium, and long term, it will enable you to make the better decision that suits your specific financial circumstances. I hope this gives you a little bit of insight into the way that investors think about the financial decisions that they face on a daily basis. It's not always the best option to take door number 1. There are often door 2, 3, and 4 available. You just have to think about how it fits in your personal financial goals. Make sure you flesh out what your financial goals are each year, your savings goals, and your investing goals as a priority among them. This will help drive you in the direction to creating the best decisions for yourself when those financial decisions occur. Thank you for sticking around to the end of this video. I hope it has been insightful. Don't forget to hit that like and subscribe button, and we'll see you on the next one. Thanks, guys.